Well, as this particular stock traded higher, you would have entered the position at 49.02 because it traded lower earlier in the day. It reversed and went up, hitting your stop loss at 50.01 on the upside of this position, $50.01. You would have been stopped out of the position. Then, at the end of the day, it actually sold off and came back down under this position. If you realized that you had gotten faked out and stopped out on this position, you probably, as an aggressive trader, if you are an aggressive trader, you would have re-entered your position at 49.02, and then you would have hit at least 2 profit targets here on the short side. So sometimes fakeouts do happen. If you were entered here, you got stopped out here, you may want to re-enter the position after you see that this bar had reversed on the day into the lower 25% range, and that would have given you an opportunity to profit from this particular position. Fakeouts do happen once in a while. They're not really frequent, but they do happen occasionally. And if you do get stopped out on that's just part of the business. You do take a loss every once in a while on these types of positions. That is the risk. However, if you do see a reversal bar like this, it's a fairly low risk opportunity to re-enter the position at the end of the day and then capture profits as that breakout continues to happen on the downside. Okay, now let's talk about exit rules and strategies. There are 3 rules when it comes to exiting the strategy once you have been filled. Rule 1 is the position hits your stop loss. Remember, that's part of the business. You lose money occasionally, and you move on to your next trade, as it happened in this particular trade. Rule number 2 is that you hit 1 or more of your profit targets, which is the absolute best scenario. In this case, in American Express, we hit profit target number 1 and profit target number 2. The third rule is that we count the inside day for the trade setup as day number 1, and we exit the position at day number 4 or the close of trading on day number 3, whichever is more comfortable with your style of trading. We close the position whether or not any of the targets have been hit. In other words, we don't hang around for the trade to work. As I mentioned, either it works or we get out. Conservative players are going to exit the position at target number 1. Slightly more aggressive players may consider selling half of their position at target number 1, another half remaining position at target number 2, and then the remaining position at target number 3 if it gets hit, or on the 4th day, as we mentioned. Now, there are occasions and special situations that we need to discuss to really be comprehensive in this strategy. Number 1 is if you're trading this particular inside day and you get a gap down the very next day below your short entry price, you don't really need to do anything. Keep your order in and let the price come back up to your entry price. A gap down usually indicates strong selling activity. For example, let's say in this particular example, the price gaps down here. If the price should gap down here, it means that there's strong selling activity, and selling orders have been building up and entered before the market opens. This usually means there's a higher probability of being profitable in the short trade if your order is filled. If it gaps down to here, it trades back up to your entry price at 43.70. You short the stock at that position. Generally, it'll be actually a much better trade for you if your position is filled, and because of the selling pressure on the stock will continue and hit 1 or more of your profit targets. If the price does not come back up to your entry price, do not chase the trade. Let it go. There's always going to be another trade. Now, on the opposite end, if the stock should gap higher, actually, as it did in this example, the stock actually did gap higher than your entry price. However, it traded back down into our entry price at 44.58, in which we got filled. This is a scenario which you could have a high probability of profit, in fact, if this did happen. In this case, we did hit one or more of our profit targets, even though the stock gapped higher the very next day that we were looking to enter the position. If the stock gaps higher and does not come back to fill our entry at 44.58, do not chase the trade. Let it go. Like I said, there's always going to be another trade. Now let's take a look at some examples in different stocks. Some I've traded, some I haven't, but we can take a look at some examples of how exactly to identify an inside day, how we're going to trade it, and take a look at some examples. Now in this particular inside day here, as you can see, this is kind of interesting because actually the range of this particular inside day bar was fairly wide. It was over 80% of the previous day's bar, and normally I don't like to trade those. However, it did have a spinning top. I mean, it was a fairly narrow body here, and generally what happens is with a narrow body in candlestick terms, there's a potential change of trend. And if you take a look at this particular chart, you can see there was an uptrend. There was a pullback here with a gap below this particular bar here. Sometimes that provides resistance, sometimes it provides support, sometimes those gaps need to be filled. But in any case, I felt there was enough of a downturn in this stock at fairly high volume that maybe there was a snap coming back. So I decided to trade this particular inside bar with an entry at $70.54, which was just 1 penny higher than the inside bar that's here. It hit profit target number 1 almost immediately on day 2, or I'm sorry, on day 3, because day 1 is our inside day, day 2 is the next day, which we entered the position. On day 3, we hit profit target number 1. We never got to profit target number 2, but on day 1, 2, 3, and 4, we would have exited on the open of day 4, which is right in here, very close to our profit target number 1 on the remaining position. After that, it sold off quite dramatically, and a lot of times, here's a little bit of a nuance for those who are really interested in trading inside days, is that sometimes inside days, if you extend the highs and lows, they provide sometimes they provide support, sometimes they provide resistance, but a lot of times stocks will trade around these areas. For example, as it went up and it hit our profit target, it started to come back down again following the trend that was started back here, and it actually sold off rather dramatically. Aggressive traders may extend these channels a little bit further and take positions as they close below these channels after several days of being out of your initial trade. Sometimes those can be very, very profitable trades. Let's take a look at some other examples here. Let's pick one that we really haven't picked up on yet. Oh, here's one in particular that looks like an inside day that we could take a look at. If you take a look at this chart here, you can see there's one inside day right here, and that looks like a fairly good trading opportunity, and it probably would have been a very good trading opportunity at the time. All we have to do is set up our channels on the stock, take a look at our entry, which would be at the high of this particular inside bar was $71.10. We would have entered at $71.11, which we would have gotten filled the very next day. As it did trade down to as low as $71.05, we would have hit our profit target, probably profit target number 1 right around in here. We would have hit another profit target maybe up in here, and then our third profit target probably would have been up in here. So we would have hit all 3 profit targets on this particular inside day.